In this video, we're going to talk about market pressure and market experience. It doesn't matter what trading strategy you have. If you saw the market for 3, 4, 5, 6, 7 months and you see that the market is going up by having built a relationship to the market, it doesn't matter what trading strategy you're going with right now, it will be not good to trade against, because to be congruent with yourself is something what's very important. That means if you see that the market goes up, if you're aligned with yourself, and then you take the trading strategy to trade up, this is exactly what counts. In many cases, when you see that the market goes up, it will be, of course, good and recommended that you wait until the market starts doing a retracement. That means, for example, market goes up, and instead of trading up here now, to wait until the market does the same retracement, because the retracement of the market, what the market did here, and then to trade up in the direction what we're going through here in this video. So this is the S&P 500 future, by the way. You can see here the ES1 exclamation mark using the 1 minute chart, because we have 60 candles within 1 hour. And starting here, you see that we have here the US session. I was setting this one a bit up different. I would need to set here up 1 hour before. And then down the right, you have the time zone. This is the New York session time. New York session time starts at 10 a.m. 9:30 to be exact, but starting 10 a.m. is a very good trading time. And then starting 10 a.m., the market will aim for the bigger structure highs and lows. So make sure you make the chart always as small as possible. You draw in the bigger structure high, for example, here, the bigger structure low there. I see very also experienced and beginner traders, they try to trade like this, and then they can't see what the market is aiming for. The market is always aiming for bigger structures, such as here. This one is a mid rotation, it's called. I'm going to draw this one to you in using my my drawing tool. You can see here this high here, then the market goes down, and this is the mid rotation. If you put everything together in a higher time frame, it will look like this. And this is what the market is aiming for. Or, of course, a bigger structure low. It depends all on your experience. If I would go now to a 50-minute chart, by the way, you will see that it's literally the same thing what you can see also using a 1 minute chart. And this is the number one reason why we don't need at all to use any other chart than a 1 minute chart, because you can see mostly everything. It is very rare that you can't see anything. That there's nothing that you cannot see using the 1 minute chart. So you can see the biggest structure high, the mid rotation was here, literally here you see green, red, highest point is here. Here you see green, red, highest point is here, how the market was doing here, retracement. But this is what I mean. We can literally see this also using just the 1 minute chart, as you see here, where I put here the violet line, right? So now we have here starting the US session. Now the thing is, how can you see better that the market goes in that direction? And there are always these 3 methods that I show. That is literally, first of all, very important. You understood that the market goes up here to this bigger structure high or bigger structure low. It doesn't matter from what time zone this bigger structure high or low is. At least it's from the bigger structure high. That's already enough. And then the first way is that you see that the market is just nearby. Nearby means just like up here, for example, you can see it's more near at this mid rotation. It's called mid rotation. Then, for example, at this low. And then it makes more sense that the market starts going there. Once the market goes down here, it will make more sense that the market goes down here. Makes totally sense. But when looking at the market multiple times, you can see how it structures up here, that it makes more sense that the market more rotates up. And this sadly only comes with experience. So if you watch this video, for example, you try to implement like step number 1, it will not sadly work. But no, don't worry about this. I got for you step number 2, like a second method. It's not a step, it's a method that will help you out to read better market pressure. And that is that if you see that the market does a lot of green candles, we're talking about 4 or 5 green candles, that we see that the market either goes in a contraction phase, like it's going to wiggle around, or it's going to shoot up. If you see 4 or 5 red candles, that it's most likely that the market will go down. And the very interesting thing is that if the market goes down, it does only most likely maximum of 3 green candles. So once you see here that it does 4 green candles, or even here 6 or 7, it makes a lot of sense that the pressure is actually dead. Literally, like once the market starts here to make more green candles than green, and you can see the market goes up here, this is something what I really love, trading then in that direction, aiming for these smaller or even bigger structure highs. And then what is also very cool, the third thing is to see that the market does the same retracements. A retracement is sadly something we can only see when it's done already. It means if we see the market goes up, it will come back. And when it continues to go up, this is already called a retracement. So we only know the retracement if it actually happens. And that would be if we have a red candle that shows us that a red candle is opening on the top. it's closing on the bottom. That means within 1 minute, the market was going lower. A green candle is opening on the bottom and closing at the top. That means within 1 minute, the market was going higher. Now entering after a green candle, this is something what I think is very good. This is already a retracement because you see how the market goes back. You see how the market goes up. And before, of course, the move is finished, you need to imagine like market goes up, market comes back. This here is the high up here, what the market is aiming for in the bigger structure. And when seeing here that the market starts here to do multiple green candles, then we start trading in that direction before the market reached that high. If the market already reached that high, I'm going to show this to you. If we have here this high and the market does a retracement, if it doesn't reach, it's good. But if the market reached this high anymore, it has no more power to aim for it anything. It will go in contraction phases back and forth. And this is where a lot of traders tend to lose money. So what is very important is before the market is reaching this high. For example, here, you see a lot of green candles. You have the experience maybe that you can see that the market goes up here. And then just when the market does here now this green candle that closed, entering the trade here after the green candle closed, aiming for this smaller structure high that you see is very good before the market is aiming for that. Or for example, this bigger structure high is totally fine. In this case, we better use this one because this is from the mid rotation here. Then it makes way more sense literally because once the market is reaching this high, it will wiggle around. It will, if you have a tight stop placement, it will most likely stop also traders out. So what is very important is to understand these three things. Last thing as a bonus, what I would like to give to you for still being here with me is the small green or red candle, how to place a stop placement. When we now go to the actual market, you can see on the right side, there's a timer that counts down from 15 seconds. So it means in 15 seconds, we're expecting that the candle looks exactly like this, how it's looking like this right now. Like if it says here 2 seconds, we will look at it, how the candle is closing. And then I'm going to show you how to have a tight stop placement. Now you see 1 second and the candle is closing and this green candle is staying green. And then it opened down here because the market was moving down. When entering now a trade, here where my mouse is, where the candle closes would be good. And then the stop placement on this green candle that you see here, aiming for a bigger structure high, for example, like here, has a risk reward of 3. It depends always on the broker how much leverage we can use. And this is the number one reason why I love futures trading, because for each $400, I can use almost around $100 in the equation for each trade, using the 1 minute chart. That means if I would have like a $2,400 account, I have 20 trades that I can adjust around to $100. And we have, we have $400 that is called margin. So what we saw here right now is that the market is structuring up. It does here more green candles and it goes up. And what is very important, you see the retracement are having almost the same length. That's number 3, right? What we were talking about. So when the market structures out here, like here, the green candle is more nicer, of course, than trading this green candle. I just think it's more nicer to give you as a bonus, like watch out that the market is closing and does small green candles, because when adjusting here $100 and trading up here, that's $350. But when taking this trade here in consideration, like this green candle and the stop placement here, like when adjusting here $100, we have for the same length only 125. Like we would make only $125. So the smaller the stop placement, that makes sense, the more better it is. And the smaller the chart, the smaller the stop placement. Very important. Some say also the bigger the chart, the bigger you can see the structure. And this is true. But for intraday day trading, we can see everything as you see here in the 1 minute chart. Keep in mind to keep the chart like this. Hope you could take something out of this. Wish you all love. Good trades. JT out.